Hello everyone, and welcome back to the Web3 Daily. Today, let's dive into a market that feels both excited and on edge. Ahead of a crucial macro announcement, Bitcoin has reclaimed the 116.0 level, and Ethereum is holding strong above 4,500, sparking a nice rally across many altcoins. Honestly, my first reaction to this price action is that the market's narrative is once again completely captivated by macro sentiment. Looking at the data, the total crypto market cap has climbed back to around 3.2 trillion in the last 24 hours. The fear, greed index has also crept up from neutral territory yesterday to 60, pushing into the greed zone. The biggest driver behind this, as we all know, is the growing conviction on Wall Street that a Fed rate cut is imminent. This expectation has been like a shot of adrenaline for the market. We're clearly seeing capital flow back in, especially with the US spot Bitcoin ETFs marking their fourth consecutive day of net inflows. That's a clear sign that the smart money is already positioning itself. However, a rally driven by a single macro expectation isn't exactly standing on the firmest ground. The risk here is that if the upcoming interest rate decision doesn't live up to the market's rosy scenario, we should still be prepared for some potential short-term pullback pressure. Alright, let's really get into our main topic today. Why the entire market's mood seems to hang on the Federal Reserve's interest rate decision. It's a fascinating situation when you think about it. We're in the crypto space, yet everyone's heartbeat is synchronized to the rhythm of a traditional finance conductor's pattern. As it stands, Wall Street is treating a 25 basis point rate cut in September as a foregone conclusion. If you look at the CME's Fed Watch tool, traders have already placed their bets, pushing the probability to over 90%. What does this mean? It means a significant portion of the current rally is the market pricing in this good news ahead of time. Everyone is trying to front-run the announcement. The reason a rate cut is such a big deal for crypto is straightforward. Lower rates mean more liquidity is injected into the system. The cost of money goes down, and all that hot money needs to find a home. That's when high-risk, high-return assets like crypto suddenly look incredibly attractive. It's like opening a faucet, and the crypto market, being downstream, naturally rises with the tide. We've seen this playbook run multiple times in past cycles. But here's the point I think is worth digging into. While everyone's celebrating this impending good news, have we stopped to ask why the Fed needs to cut rates? It's usually because they're seeing troubling signs in the economic data, so we might be at a very delicate juncture. In the short term, more liquidity is a massive boost for asset prices, but in the long term, could the underlying risk of an economic recession be the next black swan event? So the situation as I see it is optimistic in the short term because the money is coming. But for the long haul, we need to stay vigilant. This rally, driven by macro sentiment, feels more like a game of expectations than a healthy, fundamentally driven bull market. The real test will come when the rate cut actually happens. We'll have to see if the market decides to treat it as a buy the rumor, sell the news event. That's when we'll find out who's been swimming naked. Now that we've covered the macro view, let's look at a really important data point. While retail investors are hesitating over the 116.0 price level, institutional money from Wall Street has already given its answer loud and clear. According to the latest data, US spot Bitcoin ETFs have seen their fourth consecutive day of net inflows, with more than 550 million coming in during the last trading day alone. When I saw that number, my first thought was that the so-called smart money has an incredibly sharp sense of smell. If you look closely, the leaders of the pack are still the two giants, BlackRock and Fidelity, whose ETF products absorbed the vast majority of these new funds. This isn't just some scattered tentative buying, this is a large-scale sustained deployment of capital. What does this tell us? It tells us that, in the eyes of institutional investors, the current macro environment, driven by rate cut expectations, represents a high certainty window of opportunity to go long. Think about it. These ETFs act like a giant reservoir for Bitcoin. Right now, the water level in that reservoir is rising steadily and consistently. This not only provides a very solid price floor for Bitcoin, but more importantly, it changes the entire market dynamic. In the past, the market might have been driven by retail sentiment, leading to wild swings. But now, with institutions acting as a stabilizing anchor, the market's depth and resilience have significantly increased. Furthermore, these sustained ETF inflows are themselves the strongest possible market indicator, attracting even more traditional capital that's been sitting on the sidelines. You could say that these ETFs are quietly stockpiling ammunition for the next potential leg up. Of course, we also have to remember that institutional flows are just as susceptible to shifts in the macro narrative. If rate cut expectations were to reverse, those outflows could be just as swift. And that's something we need to keep a close eye on. Okay, after looking at the institution's public moves, let's turn our attention on-chain for a story with a bit more mystery. At the same time, institutional players are rushing in. An ancient whale that had been dormant for 13 years has suddenly awakened. On-chain data shows that a fossil-level Bitcoin address, created way back in 2011, has made its first move after 13 years of complete silence. The nearly 50 Bitcoins held in this wallet were all transferred out in a single transaction. At current market prices, that stash is worth over $50 million. The moment this news broke, the entire community erupted. What does 13 years even mean in this space? Back then, Bitcoin was trading for just a few dollars. Ethereum didn't even exist. And the vast majority of people in crypto today hadn't even heard of it. So, the owner of this address is undoubtedly one of Bitcoin's earliest believers. Now that they've suddenly made a move, everyone is trying to guess their motives. The most common theory, of course, is profit-taking. After all, holding from a few dollars to over 110 today represents an astronomical return. Choosing to cash out now, as market sentiment is warming up, is perfectly logical. Others speculate this could be a preparatory move for future market operations, transferring funds to a new, more secure address for easier deployment later. And then there's the more romantic theory. Maybe the owner just recently found a private key they had forgotten for years. Honestly, the awakening of these ancient whales has a dual effect on market sentiment. On one hand, it's like a living legend, proving the incredible wealth that can be generated by holding Bitcoin long-term, which is a boost to market confidence. On the other hand, it's a ghost hanging over the market, a reminder that there are still many early players holding massive amounts of low-cost coins. Although the destination address in this transfer hasn't sent the coins to an exchange yet, so there's no immediate sell pressure. Any little move from these giants is enough to make the market hold its breath. After discussing Bitcoin's macro and on-chain stories, let's shift our focus to the Ethereum ecosystem. Over there, we've also seen a massive technical development, as core developers have essentially finalized the main components of the next major hard fork, the Pectra upgrade. In my view, this upgrade has two core highlights that will have a huge impact on Ethereum's future. The first is about the validator staking cap. Right now, Ethereum's staking rule is that one validator can stake a maximum of 32 ETH. If you have 320 ETH, you have to run 10 separate validators, which is cumbersome and creates a significant load on the network. This upgrade plans to raise that cap from 32 all the way to 248 ETH. Don't underestimate this change. For staking giants like Lido and Coinbase, this is fantastic news. They'll no longer need to manage tens of thousands of individual validator nodes. They can consolidate their funds, drastically reducing operational costs and the computational burden on the network. Simply put, it makes Ethereum's proof-of-stake consensus layer run more efficiently and smoothly. The second highlight is the long-awaited native support for account abstraction. The inclusion of EIP 3074 in this upgrade will allow our regular wallets, our EOAs, to gain some of the functionalities of smart contracts. What does this enable? In the future, you'll be able to use your wallet to approve multiple actions in a single transaction. Imagine selling a token, adding liquidity, and restaking, all in one click, without needing constant reconfirmations. You could even pay for gas with USDT, or have a dApp sponsor your gas fees for you. For the average user, this is a monumental leap in user experience. It's tearing down one of the last major barriers to the mass adoption of Web3 applications. So, you see, while the market is making noise about price fluctuations, Ethereum's developers have been quietly pushing the network's fundamentals forward under the surface. The Pectra upgrade makes the consensus layer more robust on one end, and brings the user experience closer to a Web 2 application on the other. This kind of foundational innovation is Ethereum's true moat. Of course, where there's sunlight, there's always a shadow. Just as we're getting excited about technological progress and the capital inflows, the security issues in the Web3 world are still sounding a loud alarm. According to a recent industry security report, in the first half of 2025 alone, the total funds lost to hacks and various scams in the Web3 space exceeded $3 billion. You heard that right? $3 billion. It's a shocking figure. surpassing the annual national budget of many small countries. This number represents hundreds of security incidents, big and small, meaning that, on average, a project or a user's wallet was compromised almost every single day. I took a close look at this report and found that this year's hacks are showing some new, more terrifying trends. In the past, we might have thought that as long as a project's smart contracts were free of bugs, our assets were relatively safe. But now, the focus of attacks has shifted from purely exploiting protocol vulnerabilities to much harder to defend supply chain and social engineering attacks. The report highlights a critical point. Many hacking syndicates, like the notorious Lazarus Group from North Korea, are increasingly using artificial intelligence to carry out their scams. They can use AI to create deepfake videos and voices of project founders, engaging you in real-time video calls that are incredibly convincing. They can even use AI to analyze on-chain data to precisely identify wealthy but less security-conscious wallets for precision phishing. What does this all mean? It means the war for Web3 security has entered a new dimension. It's no longer just a battle of technology versus technology. It's a full-spectrum conflict involving human nature, psychology, and awareness. The hackers are learning and evolving, and they're doing it frighteningly fast. This is a wake-up call for every single one of us. From now on, when we're navigating the Web3 world, we absolutely cannot afford to be complacent. Protecting your private keys and seed phrases, and being skeptical of anything that looks too good to be true is far more important than analyzing any number of candlestick charts. After that distressing security news, let's turn to a grand narrative that could be a complete game changer. In the United States, a movement to elevate Bitcoin to the level of a national strategic asset is quietly unfolding on Capitol Hill. Recently, a group of crypto-friendly US lawmakers held a closed-door roundtable discussion. The attendees were top-tier industry titans, including figures we all know well, like MicroStrategy's founder Michael Saylor and the renowned Wall Street analyst Tom Lee. The core topic of their discussion was how to advance a piece of legislation called the Strategic Bitcoin Reserve Act. The proposal in this bill is something you might find a bit wild. It suggests authorizing the US Treasury to use the nation's resources to purchase and strategically hold Bitcoin, just as it holds gold and foreign currencies. Their initial target is for the US government to hold a reserve of 1 million BTC. When I saw this news, my first thought was that the scale of the game these people are playing is truly beyond the imagination of the average investor. They are no longer viewing Bitcoin as a simple speculative asset, but are redefining its value from the perspective of national economic security and geopolitical strategy. Michael Saylor's core argument is that, in an era of continuous fiat currency debasement, Bitcoin is the ultimate store of value. If the US can be the first to incorporate it into its national reserves, it can maintain its leadership position in the global digital economy and even hedge against the risk of the US dollar's declining hegemony. Of course, we need to look at this rationally. The bill is still in its very early stages, and the resistance it will face in Congress will undoubtedly be immense. However, the signal this sends is, in itself, extraordinary. It shows that within the top political circles in the US, a powerful faction has begun to seriously discuss the possibility of nationalizing Bitcoin. This effectively blows the ceiling of the long-term value proposition for Bitcoin. If ETF inflows represent Wall Street's endorsement, this bill is a signal that the nation-state players are starting to consider taking a seat at the table. Finally, let's wrap up with a story that hits a bit closer to home for the average person. While the crypto-native world is still exploring all sorts of complex applications, the traditional finance giant American Express has begun to bring NFT technology to its hundreds of millions of cardholders in a much more subtle, softly approach. American Express recently announced that it will offer its members a digital version of passport stamps. Simply put, some of your real-world spending or travel experiences will now allow you to claim an exclusive NFT digital collectible as a memento within their app. For me, there are two really interesting things about this project. First, they chose to issue these NFTs on Base, Coinbase's Layer 2 network. Why Base? Because it's built on Ethereum, making it secure and decentralized, but its transaction costs are extremely low, almost negligible. This makes it perfectly suited for applications that require large-scale, high-frequency minting. Second, and this is the crucial part, American Express has deliberately hidden all the complex technical concepts like blockchain and NFT throughout the user experience. A customer doesn't need to know what a wallet is, what gas fees are, or even that what they're collecting is an NFT. All they see is a beautiful collectible digital badge. This seamless, invisible experience is exactly what Web3 technology needs to look like to achieve mainstream adoption. So you'll see, the significance of this move isn't about how much these NFTs might be worth. In fact, they are set to be non-transferable, specifically to prevent speculation. Its real importance is that a top-tier global brand like American Express is starting to use NFTs as a tool to increase user loyalty and create innovative customer experiences. This proves that the value of NFTs goes far beyond speculative JPEGs. The technology has enormous potential in areas like digital identity, membership systems, and brand marketing. This kind of non-speculative application, driven by traditional giants, is the right way for Web3 technology to finally break into the mainstream. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we're here, sorting through the noise to bring you the most important information in the Web3 world, the news that's closest to the money. We hope that by breaking down these key stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges down in the description box below. These are special high rebate deals we've arranged for our community to help you save a bit on trading costs. Let's all stay rational, keep moving forward steadily, and get rich slowly in the world of Web3. May all of your crypto portfolios grow steadily. We'll see you tomorrow.